This year feels impossible for option sellers, and in this video I want to go over my year-to-date statistics with broker statements, of course, why this year actually feels impossible and how to survive tough years like this one. And my name is Eli. I'm a professional option trader. I manage over $8.7 million currently, and if you're interested in mentorship, email me and we can see if we are a good fit for one another. Let's get to the video with the year-to-date statistics. And so far, I'm up 27.64% a year to date. A total trades is 12 out of 12 wins. So no losses at all this year. I've been really careful with with what trades I choose to enter or what fights I choose to go into and which ones don't. My average trade duration is almost 15 days, which is quite good. Means pretty much that I'm sitting on cash half of the month on average. I do buy some T-bills, of course, but I don't have any active options positions outside of these positions here. The average position size is 5.6% premium collected of capital. So if I have a $100,000 account, on average, I collect about $5,600 of premium per position. Now, my average margin requirements per position are 22% of capital. So some positions take a bit more margin, some positions take a bit less. My average stop loss, which is really my only stop loss, is about 50% of credit, meaning I will take a loss at 50% of credit, or I would roll it. So far, rolling has been a no-go for me. So I'll probably end up just closing the position for a 50% loss, but this is my stop loss. My year-to-date Sharpie is 2.47. If you don't know Sharpie ratio, just kind of tells you how good your performance when compared to the drawdowns on your account. So anything over 2 is really good. Anything 2.5 and above is pretty amazing. So the year-to-date Sharpie is actually lower than my average. My average is 2.98, but it's still pretty good, and I'm pretty happy with it. And I had 2 months with no activity, April and October. And this will be part of me showing you exactly why I had such a good year when a lot of option sellers unfortunately had pretty tough years. Now let me show you all my broker statements, and we'll move on to the next section. So here's a broker statement on one of my personal accounts. As you can see, this is from January 1st until October 24th, and I'm up 24.64% on the account. And obviously there's all the trades that I've done here. If you want, you can pause and kind of look at the trades and all the treasury bills that I've been holding in my account. Now, this is the risk measures for my account. So I think this probably will be the most interesting thing to look at. The drawdowns, I guess my max drawdown was 4.41%. And this was not from capital, like from the initial capital, it was from my highest point. And I think the recovery was 3 days, so I recovered pretty quickly. It wasn't on a natural gas position. You can see the Sharpie is 2.47, and overall about 88% of days I'm positive on my account, and only 11 days I'm actually have unrealized losses. So it's pretty simple, and this is just gonna give you a proof of of what I'm talking about. And let's get on to why it actually feels impossible to trade this year. There are a few things that make this year seem really impossible, really tough, which it actually was, right? Not just, it doesn't just seem impossible, it is pretty hard. And first thing is obviously the tariffs, March to November, still kind of active. We still have some ongoing tariff negotiations, or not us, but the US. And tariffs proven to create volatility in the stock market and especially in the commodity market, because tariffs really affect the commodity market even more than they affect the stock market. So for me, someone who sells options on commodities, it's a pretty big thing, and it's been pretty challenging to navigate. Second thing is obviously Trump. Sudden announcements, often on social media, and create a spike in volatility. Happens a lot if you just creates some kind of post about soybeans, for example, and the price just kind of shoots up based on on just a social media post, and creates volatility and possibly gets you out of the position. So also something really problematic to kind of predict, right? Because it's impossible to predict. But I have some pretty good tricks to be able to handle it. Now, Middle East conflicts, somewhat unexpected. They just kind of happen. You don't know. This is not something is going to happen or can anticipate. Quick escalations and de-escalations. We had Israel and Iran. The whole situation in the Middle East has been pretty crazy. Then we have Russia, Ukraine. Tensions increase and decrease repeatedly. Sometimes it's in the news, sometimes it's not. And Russia-Ukraine situation can easily affect gold, crude oil, maybe wheat, because Russia and Ukraine exports a lot of wheat to the world. Now we have the U.S. government shutdown. It's still ongoing and no telling how the market will react if it continues. It might not have as much to do with commodities, but crude oil also can be affected. Gold can be affected by the U.S. government shutdown. These are things that I trade. And the biggest issue is silent price movements and volatility expansions, which is the biggest problem for option sellers. It's very hard to protect against this other than having small position size for the most part. However, it can be also ineffective. It doesn't matter if your position size is really, really small. Sometimes things get really out of control. And this year has been by far the most challenging year I had to navigate. Now let's talk about how you can actually go through years like this, and it's actually simpler than you might think. So how to survive tough years like this one? Number one, I keep position size small. We just talked about it. For myself, it is up to 8% of account capital in premium, and as you can see, my average is actually 5.6. But if I collect 8% of my account in capital, I risk about 4% per trade of my total account capital, right? So my average is 5.6 percent. So I only risk 50% of that based on my stop loss. So my actual risk is 2.8%, which is not bad at all, considering that this is the risk I take per trade, and I don't take many trades. Now, this one is a pretty simple one. Now, this is the really juicy stuff. So I avoid trading through known upcoming major events. So, for example, we all knew way ahead of time April 2nd tariffs announcements. It's a known tariff deadline, and obviously there's also no negotiation dates with China and whatnot. But these things they're all over the news. You know exactly when they're going to happen, and it's just safer to exit everything, which I did. It's not fun. Sometimes you're profiting very little and you want to profit more, but it doesn't matter. You have to exit before these things come into play, right? So April 2nd is the biggest one for me. It was just such an obvious place to just sit on cash, just have treasury bills. A lot of people just kept positions open, which I really don't get why. Actually, I do get why. But in terms of being a professional and really trying to be good at this business of trading, this is a non-negotiable, I guess, rule that you have to exit before things like April 2nd, where you have no idea how the market will react. You have no clue. And the market reacted pretty badly. A lot of people lost a lot of money. Same thing with known tariff deadlines and no negotiation dates. A lot of people kind of look at this and say, okay, well, this is like the chicken approach, but it works, and then it works for me, and I've been doing it for 10 years at this point, and this is a major way to deal with years like this. Some years are much simpler. You have basically no news, no conflicts, and they're amazing to trade. These years, everyone makes money in these years usually, but years like this one, this is where people blow their accounts, right? So this is what we want to focus on, not the good years. Good years they're good years for everyone. Bad years are the ones that you want to be doing really well. Now, third thing is I avoid exposure to the risky direction. So, for example, the Russia-Ukraine conflict can suddenly cause crude oil prices to increase. Therefore, there won't be any exposure to the upside for myself. Now, it depends on the situation, but let's say we know that gold crashes upwards, right? So if things get really bad, and there's a lot of reason for things to escalate, Russia, Ukraine, Middle East, tariffs, government shutdown. If these things happen, gold will go up basically it crashes upwards. So for me, it means that there's a lot of risk to the upside currently in this stage of the economy. So I will only ever sell puts on gold, right? So if things do go crazy, price will increase. I will actually profit from it. If it doesn't, price just keeps going sideways, I'm gonna be fine. And this is also a big thing to understand. And for me this year, for example, a bit more mainstream example, if you look at the S&P, the ES, right? A lot of people just sell short puts. This year, as soon as Trump took office, I will probably stop selling puts. I will wait for volatility to be created and only then sell very, very expensive puts very far out of the money. But I wouldn't just sell puts all the time, which is what most people do, because we know the market is crashing downwards. The ES will crash downwards, volatility will go up. You will be in a lot of pain if you sold puts just before that. But if you sold puts after that, you have a much higher probability of making money very quickly as well, with very minimal risk, right? This is also a big thing. Now, last thing is, if there is exposure to the risky side, which I try to make sure there isn't any, but if there is, I would exit the position as soon as critical news are released. The risk is simply not worth the reward. So I think also it's pretty self-explanatory. If you do have short puts, for example, on the ES, and the April 2nd tariffs are coming up, you might exit the position, and even if you don't exit it right before April 2nd, if you exit it after April 2nd, so let's say the first day the market went down, things went crazy, you would exit there, right? You would exit for probably a loss, which is totally fine. But if you wouldn't, the price kept going down and down, and eventually it recovered, of course. But before that, you would have probably been stopped out, or your broker would have closed your positions, because your margin would have increased so much that you don't have any more liquidity, which did happen for a few people, right? So you just have to be able to get out of the position. Ideally, way before there's some announcements, and avoid having any risk to the side that can explode in price movement, right? But if you're already there, then you definitely want to act quickly and get out of it. So this is what worked for me. This is, I think, really simple, makes a lot of sense. Not as easy to execute because people, greed is a real thing in trading. People just cannot take a loss. People want to make more money, especially with option sellings, where you just make money most of the time, and then you lose a trade here, a trade there. So you're accustomed to winning all the time. And when you need to take a loss, you really don't want to, and then you end up just taking a massive loss because of this, this approach, this attitude. Last thing I want to say is it is okay not to trade and watch from the sidelines. Something I've learned quite a bit over the years. When the odds are clearly not in your favor, and there's a lot of uncertainty in the markets or in the products you're trading, you don't have to trade. You can just watch from the sidelines, have your money in treasury bills. They're still paying quite well for now, and just kind of watch and see and choose your fight. And yeah, a lot of times you will miss some really good trades, or some profitable trades. Maybe not good trades, but profitable trades. And it's just the nature of the business. You're not, you cannot catch all the trades, but you can definitely be really responsible and professional, and only go for the really high probability trades and have a pretty nice return with extremely low risk. So this is it for the video. If you have any questions, let me know in the comments. And again, hopefully it was useful for you to watch. And if you have any questions, like I said, comments or message me personally, and I will catch you in the next one.